Well, thank you very much for having me here today, Dan, and Happy New Year to everybody. Let's everybody start off a great year, hopefully, and have a wonderful 2018. So what we're going to talk about here today is options, one of my favorite subjects. That, along with directional trading and options combined, makes it just a really great trading vehicle and way to trade. So we're going to talk about, how to incorporate selling options for both income, profits, and what I call opportunistic hedging. So kind of a 7-step plan put together to show you a process of how to, use options and incorporate it into your trading. So let us get started. So again, thanks for the introduction. Yeah, I've been actively trading for over 30 years and was fortunate to be involved in the oil side of the business for about over 20 years. So that's where I started my career, trading cargoes of oil. And it was a great experience, but went on to join a company called Transworld Oil, which was one of the largest oil trading companies in the world, and became the executive vice president there. So it was a great learning experience for me to be able to see all the different markets, trade all the different markets, and you tend to learn a lot of things from your mistakes. So that's what I'd like to incorporate into my teaching, is some of the things that the hard knocks, the ways that I learned a lot of things that you make mistakes on, are the things that you remember the most. So it's really been a helpful experience when I was looking back over my career. What can I do to present and help individual traders? So basically what I thought would be the best way to trade for my own account and then to teach other people is look at the markets on a directional basis first, and then incorporate options to give you great leverage to the upside, but also maintaining really good risk control. So that's really what I'm all about, is risk control and providing you really good trade setups based on direction, and then incorporating options. So the following webinar here today is going to be purely for educational purposes. Any stocks, options, futures, ETFs mentioned does not constitute advice and should not be construed as a recommendation. So we're going to talk about step 1 here, is the secret to trading profits using options. Now, option trading has so many more advantages than, just trading stocks outright or futures. But as you probably know, it can be a bit more complicated as well. Now, once you understand the benefits and the advantages of option spreads, you're really going to never want to look back and do anything different. So it really has become kind of the key to swing trading as far as the kind of style of trading I like. And that's the types of trades that will last. It could be one-day trade, swing trade, or it could last 1 week to 2 weeks. That's kind of the time frame I look at. Anywhere from one day to 2 weeks. That's kind of a short duration trade setup, and we call that the swing trade, because we're looking for cycle lows and highs in a short duration period of time. And when you're trading, remember that time equals risk. So the longer you're exposed to a trade, the more things that can happen. So I like to keep things kind of a short duration. Now, why use options? Well, when you look at the unique option pricing structures and the capabilities that actually option spreads offer you, you can really control the probabilities. And the probabilities, then you can have a better way to tilt those way in your favor when using the correct option spreads. Now, when you're looking at option spreads, what they can do and really help you to maintain is control your capital at risk. So you can get very low capital at risk. You can really define all your trading risk in each trade before you even put it on. And options are set up to provide you really with great leverage, so you don't have to put up as much money, and you can make really fantastic returns. Now, step 2 is then, well, how do you maximize your option trading profits? So it really comes down to knowing how the option pricing works, and then, using the right strategy based on the market situation you're in, taking advantage of the option pricing model and the advantages that options give you. So the biggest component for options really comes down to price. And pricing component, when you're looking at options, the biggest factor that really makes an impact on the price of the option is time. So time is one of the major components for pricing, and we're going to go through that and show you how kind of the timing aspect of it works, time decay, etc. Now, what exactly is time decay or time value? The time value of an option is also referred to the extrinsic value of the option. So it's the premium a rational, sane investor would be willing to pay over its current exercise value, known as the intrinsic value, based on its potential to increase in value before expiring. Now, this probability is going to always be greater than zero. Thus, an option is always going to be worth more than its current exercise value. And the change in the value of an option based on time decay, and we can measure time decay, which is another great thing with options. We can measure these various things that affect price using the Greeks, and for time decay, we use the Greek called theta. Now, the option theta, the characteristics are going to be either a positive impact on your price or a negative impact. So when you're long a stock option, so let's say you went long a call option or a put option, that's going to have what we call a negative theta value. So it's going to indicate that it would actually lose value each and every day as expiration draws nearer if the price doesn't change. So if you're going strictly buying options all the time, if you buy a call, buy a put, and the price of the option or price of the underlying goes nowhere, goes sideways, you're going to start losing money each and every day, and it's going to accelerate as you get closer to expiration. So it's a negative theta, characteristic. Now the opposite of that is if you're short options. So if you're short a call or short a put, that's going to have positive theta value. So if the price of your underlying goes nowhere or goes sideways or even up a little bit, it's going to give you a positive gain each and every day. So that's the two, major benefits of understanding, option pricing, and that's one of the big components there is time. So then let's go through the option pricing model and just kind of look at the components and how they affect price. So again, the key component will be time value, and then the other big component for pricing is the implied volatility, then times your underlying value of your security you're trading, the intrinsic, extrinsic together. Now, once you know these variables, then you're going to be ready to price, price out your option, know what the option premium should be, and then, have a better idea of what kind of option strategy you want to use. So here's a table, and we'll illustrate how these pricing components affect price. So let me get up a drawing tool here. So if we look here at this table, this is based on a weekly option. So every Thursday, we'll have a new weekly option series. So tomorrow, we'll get a brand new series. And the great thing with options now, most all the companies or stocks or whatever, ETFs, they're all having weekly options. So you can price out an option trade each and every week and really keep your trade duration short and take advantage of, these components of price. So if we look here on a Thursday, we're going to have 100% price that first day. So if we take time value times the implied volatility, and this is all going to be given to you on your option model, and I'm just using these as examples so you can see how it affects the price or the premium. So time value times the implied volatility, and so here I put that at 300, and then times the underlying value of your security you're trading, and we're going to keep that at 1. So you can see how basically time value component of the option and the implied volatility affect price. So if you multiply these together, it gives you your option premium, the price of the option. So the first day you've got 100% time times your implied volatility times the underlying. So that volume, that option price would be $300 in this example. Now if you look here to Monday, you can see down here when you come back in over a weekend, that time component is cut in half. So you can see how that now is decayed, and that's cut in half. So even if the price had not moved at all, that's what it's going to be. That time element is going down each and every day. And even if you, spike up the implied volatility in this example to 800, you can see that it barely pushed the price higher. So let's say if you had the implied volatility here of only 200, and now your time portion of the option was cut in half to 50% of it, you can see that your option value would now be only $100. So the big takeaway here is that you can see how the effect of time and implied volatility really has an impact on your option. And the big takeaway here is you can see that time will go to 0 and implied volatility will go to 0. So if you're, again, long an option and you know that time value is going to 0, implied volatility is going to 0, you better have that directional trade set up where it's really going to perform for you fast, or else you're going to be losing on each and every trade. Now, the other side of that, you can take advantage of it too. Now, I like to buy options too, but I also like to sell and incorporate selling strategies to take advantage of these, time value and implied volatility. So that's kind of what I'm really kind of drawing on here today to talk about. Now, step 3 then comes out to selecting the right strategy, the option strategy for the, market condition that you're in. And in my opinion, one major goal of every trader really should be to select trades that are based on what's going to provide the most consistent positive return with low defined risk, and not always, the greatest return. So if you can be more consistent in your trading, just kind of chip, 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 every now and then you're going to hit, a triple or maybe even a home run. But if you can be very consistent, you're going to stay in the game a lot longer and be a lot less stressed out and make good, consistent profits rather than having a wild equity curve on your, your account. And one way to achieve this is by then knowing the best low-risk option strategies that are available, how they work, and then selecting the one that's going to be best suited for the market environment you're trading in. So everybody here today, if you look at John or Sarah or Susan, you're going to all have different amounts of capital to trade, different times of day that you can trade. So you're going to have to take all that into your, kind of your trading plan to see, what your risk profile is, how do you want to trade. So by knowing the different strategies, then you can adapt and pick the ones that are best suited for your, risk profile in the days that you can trade or the time of day that you can trade. So it's important to understand each and every one and then focus in on the ones you like. So we're going to look at a few here today, and I'll show you the ones these are my favorites. So when I'm looking at low-risk option strategies, what I like to look at is incorporating selling option credit spreads. And you can do this just from a standpoint of a trade by itself to bring in income or profit. Or the great thing about understanding how to sell options and credit spreads is that you can then incorporate and combine this strategy with other long strategies to put together different types of spreads. And I kind of call it like an option puzzle. So we're going to look at selling option credit spreads, the balanced butterfly spread, which is just an amazing, fantastic high reward to risk, and also very, very low defined risk. The condor spread, which is kind of a different, similar to a butterfly, but you're skipping some strikes on your short end, which we'll go look at. And then what I call the ninja credit spread, which is a ratio butterfly, and then hedging. So when you incorporate, selling options and all these various strategies together, you can really come up with some great what I call opportunistic hedging or defensive strategies for option trading. And it really comes down to at points in time with your trading, you're going to need to defend trades, know what to do if the market's, starting to go against you. So, what I always teach is, a plan where you have a plan of action before you even put the trade on. You know what your trading defense is going to be if things go against you, and that's where you can incorporate these types of strategies. So, why would you look to sell options and option credit spreads? Well, when you get down into the nitty-gritty of it, you're going to see that when you're selling options, and selling out of the money type options, they can work regardless of market direction. So you can even be wrong to a certain extent on direction and still have a winning trade when you're selling options and option credit spreads. Now, the other great thing too, when you look at the statistics, of out of the money type options, when you're selling it, the winning probabilities of profit when you're looking at selling like a 1 standard deviation out of the money is going to be 80% or greater. And that's based on just statistics going back and looking at, over and over and over how these work when you're selling out of the money. So even without adding technical analysis, when you're starting out a trade at setting that 1 standard deviation out of the money when you're selling it, that starts you out with this 80% chance of that being a winning trade. And just think about it, if you have then a winning trading system that's better than 50-50, that then increases your winning percentage even greater. So if you have a trading system that's 60% of the time it's right, then you just increased your winning percentage by 10 basis points. So you've got like a 90% probability that that trade will work. So that's the great thing when you understand the difference in these types of option strategies. And the great thing too is it's perfect for hedging when you're incorporating selling options and option credit spreads into your trading. So remember that options started out and were put together as a way to hedge positions. So it gives you an option to defend the trade, to hedge position. So that's where they were created. And options have become more kind of a profit center for a lot of traders versus a hedging. And in this past year, when we had such a big up market bull market run, a lot of people have just kind of forgotten about, hedging, et cetera, because every time you were putting on a hedge, a lot of times the hedges were losing. But you need to understand the risk of every trade you put on, and then how to manage that risk, and options are the perfect way if you understand the different strategies. So step 4, then let's look at how you trade time and why you would sell a credit spread or sell an option to either make profit, make income, or hedge a position, because it all comes down again to time, and options are the perfect way to incorporate that and trade time. So when you look at credit spreads, now I like to look at the credit spread side of things. You could just sell a naked call, or you could sell a naked put, but you have so much more exposure. So if you're not a very advanced trader with a good solid capital account, you can really burn up your trading account real quick with just 1 or 2 bad positions. So I always recommend looking at all these different trades as a spread, so you know what your risk is. You cap your risk. Now, by doing that, you're going to cap your profits, but you're going to be able to sleep a lot better. You're going to have more consistent returns. So when we're looking at credit spreads, there are 3 types of basic credit spreads. You've got the bear call credit spread. Okay, so that's a bearish kind of trade setup. You've got the bull put credit spread, bullish setup. And then when you combine these 2 together, that's what we call the long iron condor. So if you look at a bear call credit spread, it's one strategy that you're going to want to do if you think the market's going to go down. So you're basically going to be selling a call with a lower strike while simultaneously at the same time buying a call with a higher strike in the same month. So you've got a cap position as far as risk, but you've also got a capped return. But it's a really, when you set these up properly, you can start to trade out with a higher probability of winning, based on those statistics. So this is what we call the bear call credit spread. Now, if you look at this example, this is, down here, you can see this slide right here. Let me pull up my drawing tool. So this is on the S&P 500 SPX, which is a really good index for, using for all kinds of different option strategies, but especially for credit spreads. So you can see in this example, it was trading down here at about 1988. Okay, so up here was selling an out-of-the-money bear call credit spread. So you can see this red line, that's the short strike, and that short strike's 20.45. And then the green line above it's 20.50, so that's your the option strike that you're buying. So this is a capped risk. So if you look at this example, you're selling this 20.45 strike short right here, buying the 20.45 above it. So that's a $5 wide spread, or $500 spread width. Okay, so on this example, you brought in $100 credit. All right, so that goes straight into your bank account, so $100. Now your risk is the difference then between the spread width of 500 minus your credit. So the maximum risk on this trade would be 400. If everything blew up and this thing went straight up, you could lose $400, but at least you know what your risk is. If you had just sold the naked call at 20.45, your upside risk to the upside is unlimited. Now the difference here is, this $100 is your maximum potential profit. And the at-risk 400 is what you would have to put up with your broker for margin to take care of that potential risk of 400. So your return is going to be on, that margin that you put up of 400. And if this thing, closes below that short strike, you're going to keep the $100 as your credit. That would be one option contract. And that return then over your risk of 400 would be a 25% return on your capital at risk, or the margin that you have to put up. So these can be a great way to just kind of be consistently in the game, making money, but with also capped risk. Now, that $400 is your maximum at risk, but there are a lot of different ways that you can defend that trade so you never lose the full amount that you have at risk. So one other rule that I always incorporate and teach is never lose the full at risk. So if you do a debit spread, and let's say you put up $100 you've got at risk, don't ever lose that full $100. Get yourself out of it before that happens. And on a credit spread, never lose the at-risk, the maximum at risk there, because you could do 9 out of 10 trades. They could be winning trades, and you have one that blows up and wipes out your return. So you need to be able to know how to defend that and make adjustments, which, I teach how to do that. But, you can see here all that room to the upside. And so in this example, that's about 1 standard deviation out. So that would be starting with about an 80% probability that this trade price will close under that 2045. So you can see you start the trade out with a good kind of high winning probability. And that's why your returns are going to be less than if you're just buying straight options. So this, if you look at it, you're risking 400 to make 100. So that's what we call a negative risk reward. Okay, but you're getting that negative risk ratio because you're starting this trade out with a higher chance of winning. So that's what we call the bear call credit spread. Now, the bull put credit spread is going to be used if you think the market's going to go up, but it doesn't have to go straight up. It could just go sideways, and you're still going to make money on these because of that time decay element. So this would be selling a put while simultaneously buying another put with a lower strike and in the same month, and that's kind of your hedge or your cap on that trade, so you're not totally exposed. So in this example, you can see this is an example. This was on Win, and it was trading right here at $207. So this was a bullish strategy looking to have Win move higher, but by selling it out of the money put spread down here, you can see you're selling way out of the money. Again, this is about 1 standard deviation out. So this was selling a 187 put short, and then under it buying the 182. Okay, so again, a $5 wide spread, which equals for one option contract $500. Okay, that's the spread width. And then the credit received on this was 130. So that's your potential profit, 130, if it closes above the short strike here, that red line. So your maximum at risk then is 370, the difference. So if this totally collapsed and you didn't have time to make any adjustments or hedge, you would lose 370. But at least you're, defining your risk going into the trade, knowing what it is. But usually you're going to always have a chance to do some types of adjustments, and there are a lot of different ways to defend these types of trades. But as long as this closes above that short strike here, you keep the $130, and on that risk, which is your margin you put up for one contract, that's a 35% return. So these are, really nice returns. I mean, these are not, the big, 1,000% or whatever that you might get with some of these crazy wild type of securities, Bitcoin, or et cetera. But these are really nice, consistent types of ways to add to your trading portfolio. So you can mix a lot of these different things and have different trading portfolio's of different styles that you want to trade. So this is just a great way to blend it in with your overall trading, or it might be that you want to just trade these outright, and this is the only way you want to trade. So that's what we call the bull put credit spread. Now, the next thing I want to show you is that the risk between these two different strategies. So we're going to look at the risk versus reward, and in this example, I'm going to show you, what the risk reward would be on two long directional option strategies. So you're going to see that strategy one will be if you just, want to go long calls, you're really bullish on the market, and we're just going to go for it, and we're going to, try to knock it out of the park. So we want to just buy calls. Okay, so we're going to look at the risk reward on that versus strategy two will be also bullish strategy, but this is going to be selling an out of the money bull put credit spread. Okay, so you're going to see the difference between the two, and you can decide, then which one you like better, or see the difference in the two strategies and see how they can, actually complement your trading. So here's strategy one would be just buying directional calls. And so in this example, Win was trading at $207. So you decided you're very bullish. You want to just go out and buy those at the money calls. So you buy the $207 strike. It costs you $11.40 per option contract. So that'd be $1,140 for one contract. All right, so the great thing here is that if Win goes up, you have infinite potential profit, okay? Now, again, you're defining your risk because you are buying this as an option. So the maximum you can lose here is $1,140. Now, that might be a lot of money to some traders as well. One contract, $1,140, but, you've got great upside potential. Now, the other strategy also is bullish, and this is selling that out of the money bull put credit spread. So this is selling the 187, 182 bull put credit spread. And when this was set up, you're going to see that it was set up way out of the money below where the low was, which had been 189, and it was like 9.5% below where Win was trading at the time of 207. So let's compare the risk of these two different strategies that are both bullish strategies. So strategy one here is, buying the 207 call, paying 1,140. Now, so John, let's say we'll have John bought this call when it was trading right here at 207, and then all of a sudden everything was looking great, but then everything collapsed. You can see it just rolled over and collapsed, and before he could do anything, it was trading down here at 196. So John opens up his P&L and he looks at it, and wow, he's down $583 on this option contract, and it just happened, in a blink of an eye. All right, so that's the danger there of just, being straight outright long. Now, if it went straight up, John's going to make a fortune, but if it goes straight down, he's losing money really fast. All right, so that's what that looks like. Now, the next few days later, though, Win goes back up to $205, and so John's thinking a little bit, hey, maybe it's coming back. I'm feeling a little bit better. It's trading right in here. So he opens up his P&L, but he's still down $518, on that long call. So that's, just the usual, let's go long options to participate in an upside move in this situation calls. Now, Susan, on the other hand, was bullish as well, but she did a out-of-the-money bull put credit spread. So she sold this bull put credit spread down here, the 187 put, bought the 182 below it. So nice spread down here. And as long as Win trades and stays above her short strike of the spread, even if it comes down, she can still make money. So she put the spread setup on. She got $130 credit. Okay, that goes straight in her account. And then the market rolls over. So let's take a look and see what happens on this strategy. So she opens up her P&L on that, the 8th of May. It was traded at 196. And instead of losing like John, he was down 583. Susan was only down $38.50. So you can see a huge difference between the risk and reward, or the risk of these two bullish strategies. So that's at 196. A few days later, Win is trading back up here at 205. So Susan opens up her P&L, and she looks at her, her open up P&L right here. Now she's up $78.50, but you can see John is still down $518. So that's the major difference that you can see. You can see just how your reward to risk is different. You're not going to make as much, but you're not going to lose as much either. And so it's a really good blend of a way to trade options for profits and for hedging. So I'm going to show you some ways that you can then also blend these types of strategies together to hedge a position. So once again, I call it kind of like an option puzzle. So you can be long a call and then you sell another call out of the money to lock in some protection, or you can be long a call debit spread and you sell a credit spread against it, and it totally shifts the dynamic and the structure of that risk profile of that trade. So we'll look at a few of these different examples so you can see how when you start blending these, it can really be a fantastic kind of aha moment for you and for your trading. So step 5 then is, in my opinion, trading really comes down to first direction, and markets never go straight up and they never go straight down. So markets tend to cycle. They'll go up, you'll see a market that's, let's say, been in a range. You can see last year we had a huge move up, and what you want to try to do is also just try to get in sync with the market. So when you look at markets, they're usually going to be trending some either up or down. So you don't want to buy at the top of a channel, then ride it all the way down. Now, if you've got deep pockets and you don't mind the stress, you could buy it here, and then later on you'll see it's probably back up here. But what you want to try to do, and what I've kind of totally modeled my trading around, is trying to pick these cycles. So you want to try to get in closer to like a cycle low right here, and then ride it up, take profit, get back in here or something like that. So cycles, markets never, again, usually tend to go straight up, straight down. They're going to cycle. So in order to take advantage of these cycles and trade around a cycle, then you need some kind of directional tools to help you do that. So one really nice tool that we put together, I'm going to show you right here. And then this is also something that I'm going to offer you today. If you want this will be just this will be a bonus, free bonus actually, this software. So here's what I've developed. This is called what we call the cycle reversal indicator. So basically it's an overbought, oversold indicator, and it's got a lower study and an upper study. So what I like to use it for is to for trading credit spreads and giving you that first alert to directional change. So here's the NDX NASDAQ 100. Here's an example of a cycle reversal, and this just came yesterday. So with this tool, this software tool, it'll give you this lower study here will show you where the actual trade came when this crosses this yellow line. That's what sets this trigger off for this reversal based on overbought, oversold. And then it gives you this arrow, nice little arrow there you can see. So here's the cycle reversal yesterday on NDX. So what this is great for is that when you see the cycle reversal starting to happen, you can sell an out-of-the-money bull put credit spread down here to take advantage of that move. Now, you never know if it's going to explode like it did, but let's say it just goes and reverses and just steadily climbs up. So it gives you a great directional tool for selling bull put credit spreads, or opposite, if you get a reversal to the downside, selling out of the money bear call credit spreads. So that's an example on NDX, okay, cycle reversal. And it's a real visual tool. And here's an example on Apple. Now this is on a 4-hour chart on the left and a daily chart. So you can see on the 4-hour, it's a faster time frame, but look, yesterday you had that cycle reversal, and today a fall through, and now you've got the daily reversal. So that's just an example there. Here's Alibaba. We did this setup yesterday. We had a cycle reversal here yesterday. Here's the 4-hour. So this gave us a nice trade setup entry. And you see here's the daily. Okay, so a reversal. Now, this is what we use it for, is kind of an alert to a potential cycle change. And then we use momentum. You can see over here on the right chart, these are momentum-based indicators. So if you have momentum, then you're going to get falter. With no momentum, the market will usually falter in that that directional falter. But that's the reversal. Now here you can see when, and this was a cycle reversal that came about 4 days ago, and you can see then what developed on when. It just started to crumble. So here's when, cycle reversal back here last week, and then you can just see it just started to crumble. And so today we had a nice short setup. We saw this, and it gives you time to start looking at trades ahead of time. And today we set up a short trade right here on this break of this Fibonacci 50% retracement level, and that's on when. So that's another example of a reversal, and then that momentum follow through. And then the next one is, let me pull up the next chart. Here is just FANG. Okay, so here's Amazon, Google, Netflix, Facebook, NVIDIA. So I like to track all these together kind of as a proxy of the tech market. So here you can see just a huge reversals yesterday on Amazon. Here's a reversal on Google, reversal on Netflix, reversal on Facebook, reversal on NVIDIA. So you get all these going together, and that really ignites the market. So just another example there. And here's one last example. Here was a reversals on FANG to the downside. This came in middle of November. So you can see everything reversed, and then we got a pretty decent little sell-off on technology. So that's something I always look at to incorporate. And this is something that anybody here today, you can have this at the end of the presentation. I'll show you how you can get this indicator if you'd like it. Now, step 6 is, what are the trade, option trade strategies that give you these really kind of low risk, high reward type setups. So I've kind of broken it down here, and we'll go through these different trades so you can see how they work. So one is the balanced butterfly. The other one I'll show you is the condor spread, and then the ninja credit spread, which is what we call a ratio butterfly, and the credit spread. So these are some trade setups. These are some of my favorites here. And let's go through and look at the butterfly first. So this is a typical, what we call a balanced butterfly. And so the spread width is going to be the same on each side. So if you just look at this, basically it's very simplistic. So basically all it is this could be used calls or puts. So you're going to have a debit spread. So that could be a call debit spread here. And then the other side of it is a credit spread, okay? The butterfly then shares the same short strike, okay? So that's what makes it the butterfly. and it gives you a fantastic positive risk-reward ratio. So for example, XYZ is trading at $45, and we're looking for a price target down to 43. I always incorporate Fibonacci levels for price targets. So we came up with, a price target of 43 based on Fibonacci. So we're looking for a move down to $43, and these can be very short duration trades, very small moves, and still make really big returns on your at risk. So in this example, you're going to buy to open one contract of the January 42 call. You pay $2.38. That's a debit, so that'd be $238. And then you're going to sell two January 43 calls. So we're targeting 43. So that's our target. So we're going to have that as our body. So that's the short strike body. And for doing that, we're going to get $1.67 per contract. So we're doing this selling it 2 times. So we're going to get $1.67 twice. And then we're going to buy to open the Jan 44 call. We're going to pay $1.06. So you can see here it's a 42 from 43. That's a dollar wide spread, very, very narrow spread. So if you look here, your net debit then is $238 right here, $238 plus the other debit of $1.06, 106, minus the 2 short strikes at 167 times 100 to convert it to an option spread contract. So your spread is your maximum at risk here, then you can see is going to be $10. Very, very low risk, $10. That would be the maximum you'd lose if everything fell apart on you. And your profit then is going to be taking the middle strike, 43, less that lower strike of 42, dollar wide spread, less the debit cost of 10 times 100. So in this particular trade example, you've got a theoretical potential profit of 90 cents here. All right, so 43 minus 42 minus your debit, 90 cents or $90. That's your potential. If everything was perfect, you could make $90 on one spread. And on your risk of 10, that's a 900% return, or what we call a 9-to-1 positive risk ratio. So these offer very low risk trade, very high payoff if you get that directional target right. Okay, so here's an example on this butterfly. This was on Home Depot about a week ago, and this was a directional target trade. So Home Depot on the 18th of December was trading at 183.50 right here, and we were looking for a target. So it's trading right here. We were looking for a target up here to this Fibonacci extension of the 1272, which was coming in at 188. Now, the other thing too is I like to look at what we call volatility squeeze, and that's a condition that I look for. And in this particular trade, there was no volatility squeeze. So this was going to be probably a trade that would kind of grind higher into Christmas. So wasn't looking for it to really explode much more than past that 1272. So we set this up on the 18th for an expiration on the 22nd, just 4 days later, and it went right to that fib level. So you can see it went right up here to that 188. Now here's the trade setup, very low risk trade. And this was using puts because we were thinking about converting it to a ratio butterfly, which I'll show you here in a few minutes. So this was, the setup was on the 18th, and this was entering into the trade. It was buying the 190, sell the 187.5 put, then you sell the 187.5 again, buy the 185. So you can see down here it was a 1 by 2 by 3, and this cost 64 cents or $64 as your debit on that spread. So if you just break that down, you can see this is a put debit spread, and then here's a bull put credit spread, and you're selling that twice, okay? So the potential theoretical profit here is 186 if you take your 250 spread width minus your cost here of 64. That gives you your potential theoretical profit of $186 per spread, which would be on that risk of 200, would be 290% return or 2.9-to-1 risk reward positive. Now this lasted 44 days and just waited into expiration and closed it out with 130 per spread, which is a 200% return, and really doesn't take much work, once you're into the trade, and very low risk. So here's what it looks like, and this is what we call the profit tent. Okay, so on a butterfly, a balanced butterfly, you can see how the strike is. Here's your 190, okay, put long. Here's your 187.5 short. So here's a put debit spread, and then here's a bull put credit spread where you're short the 187 here, long the 185. So these are both balanced $2.50 wide spread. So the max profit will be at the top apex part of this tent. So if it gets up to the top part of that tent, that's your maximum profit. And the reason you're getting that maximum profit, what makes this work, is that time decay. Also, volatility goes to zero right at expiration, so it gives you that high return on your capital. So you can see here that little black area there, that's what's left of your time decay and implied volatility, but it got to right here going into the close. So it got to 188.13 right around there. And so, you know, that 64-cent debit went to $195 debit, which gave you a profit then of $131 per spread on your risk of 64. So that's your 200% return 4 days later. So you can see here on just 3 spreads, you know, makes over $390 and very low at risk. So that's what we call the balanced butterfly. And you can use calls or puts. And, you know, in the course that I offer, you can, you know, I teach you how to do it and why to do it with calls, why you would do it with puts. So that's what we call it. Now, again, here, watch this. So this is what we call that balanced butterfly. So the next trade setup I'm going to show you is what we call the condor, the long condor. And the main difference is that it's not going to share the same short strike here. So here that short strike was 187, okay, for both the short put, both short puts, okay. Now the condor, you're going to skip strikes, so you're going to have a wider profit zone. And that's the thing I love about the condor. So let's take a look at the condor here. So this is an example on Western Digital, okay. And so here's what the condor looks like. Instead of having that short strike share in the same short strike, you're going to skip strikes. So here's say a long call debit spread, and here's the bear call credit spread. So the butterfly would have been like that, sharing this strike. But what we want to do is go out, further out, and see if we can get a premium to create that structure, and that's what's called the condor. So it's not an iron condor. This is different. So this is what we call the long condor, and you do it with calls or puts. So here's an example. So this was on Western Digital, okay, and it was trading when this was set up at $90. So the initial trade was right here. We were looking for an upside move on Western Digital. And what I like to do with these types of spreads is if the market starts to stall out, this is a way to defend a trade real quick, you know, in case the market pulls back more or stalls out. And then if you're long a call or call debit spread, you're going to start getting eaten up with time decay. So by doing this, adding this layer to it, it's going to give you that positive data and offset any negative data you would have from a long call or long call debit spread. So the initial trade was set up as a call debit spread, long call debit spread, and it was right here trading at right here. So went long a call debit spread. And then the next day, you can see it had a nice, great spike up here, and then just the next day opened up and collapsed down. So established just 1 day later a short bear call credit spread, added that to the call debit spread, and that's what creates this condor structure. So the initial trade was a long call debit spread here, okay? So the 90.5, 93, $4 debit, okay? So $4 debits are max at risk, and your potential profit is, you know, 100 would be the difference of the $2.50 wide spread. So so here's your original call debit spread, and then the next day it collapsed, so sold a bear call credit spread against it. So here you can see that 104 debit spread actually on the 22nd was going out at 203. So this actually made $99 on that part of the trade, okay? But their trades put it together as a condor, and so it actually made more when you see how this works. So 1 day later, on the 15th, it fell down, so we hedged it by selling this bear call credit spread, and sold the 94 right here, call short, bought the 96, okay? So you can see the call debit spread was a 93, and this skipped just one strike but brought in 29 credit. So that reduced the at risk, but also gives you another potential profit for this trade. So actually this trade, it closed below 94, so that credit received of 29 was max profit. So you just, that went to zero basically, and so you recovered and had that part of your trade as profit as well. So here's what it looks like when you put it together and you've got this condor. So you can see here the initial trade setup was the long call debit spread right here. Okay, so that was the 90.5, 93, and this actually skipped a strike, so it's not totally balanced. And then when it fell down the next day, sold that 94, 96, so short of the 94, bought the 96. Here's your bear call credit spread. So that puts you into a trade setup where your max at risk was now $75, okay, to the downside. That's your risk there, and your potential profit, actually this profit was 128 per spread. So you made your 99 on the debit spread, and you made $29 on the credit spread. So you made more than if you just put on and held the debit spread. So actually 170% return on your risk of 75. So it reduces your risk, but also gives you a great profit zone for that trade setup. And I like to do these all the time. It's one of my favorite structures. So you can see here just from the outright condor, when you look at the trade setup here, you can see that, 75-cent debit, that's your max risk. The max theoretical profit on this trade was 175. And this actually made, going out 128 on that risk of 75. So a great way to trade. And the other great thing about it, so, since you do have a call debit spread in this situation, and then you've got a bear call credit spread, you can leg out too. If you think it's going to not go up, you could just take profit on the debit spread side, leave the short credit spread, or do it the other way around. So it gives you a lot of different ways to maximize that trade for the benefit of either hedging or, for profits. Now here's another variation, and I call this the ninja credit spread because we're adding an additional credit spread leg to it, and it really creates a fantastic different structure. And this is also known as the ratio butterfly. Okay, so you can shape these for a directional bias to the upside or downside. For an upside directional trade, we'd use puts. For downside directional trade, we'd use calls. So you can do it as a put ratio butterfly or a call ratio butterfly. So basically, all it is it starts out, it can be structured as a spread, a balanced butterfly, and then you add additional credit spread to it, and it creates this kind of profile, risk profile. That's the shape of the structure, what it looks like. And so here's an example. We'll go through an example of a call ratio butterfly on Apple to show you how it works. But it basically comes down to just being a variation of a regular equal strike butterfly, but then adds an additional short vertical spread. So if you want to directionally shape it for an upside move, you would add a directional bull put credit spread. If you want it for a downside move, you add an additional bear call credit spread. So it simply then comes out to two in-the-money credit spreads protected by a slightly narrower, closer to the money debit spread. So it really creates a really great low defined risk directional option strategy. And by doing it this way, it alters the risk to one direction, and at the same time, that's increasing your potential reward, but your risk is still very low. So here's an example of an imbalance ratio butterfly, and this is on Apple. So again, a directional trade to start out with. So we had a reversal here on Apple, and then we had it just collapsed down, and we were looking for, based on Fibonacci, after it hit down here, it spiked back up, we were looking for a move and for this to expire somewhere right around this 160 strike. This was a 50% retracement level. And the other thing I like to look at is unusual option activity. So when we did this trade setup, there was huge amount of unusual option activity at the 160 strike on the monthly. and we had that nice Fibonacci level here at 160, so it created a great target for this trade to 160. So again, another very short duration trade set up on the 13th, and this was just to go into the expiration on the 15th. And not looking for a very big move, but you're going to see how big the returns can be on a very short duration, very small movements, and that's going to take advantage of, again, time decay, implied volatility collapse. So if you look here, so this trade setup, it was trading at 159, and we were targeting 160, so just a dollar target in just over a 3-day period. So the structure on this is a call debit spread, so the 157.5, 160, okay, $2.5 wide spread. And then this is how the directional trade is set up. We're selling the 160, buying the 162.5. So what is that? A short bear call credit spread, and doing that 2 times. So you can see there's an additional bear call credit spread here. So it's a 2-to-1 ratio, and that's where we get that ratio butterfly. And we're using calls because Apple was sitting there on this kind of support zone that if it cratered down, there was a potential for it to go much lower. So we structured it for potential downside movement. But in this short duration trade, we were targeting 160. So yeah, it worked out pretty nice, as you're going to see. So here was the initial trade set up on the 13th, just for expiration to the 15th. Okay, very short duration. Now this trade, when it was set up, usually on these trades you can get a credit, but this was a trade that we went into for just 15-cent debit. So that was the max cost, $15. So you're going to see how your downside risk is only 15. Your upside risk is greater, but there was such a huge amount of option activity at the 160 strike, and we've seen this happen about 3 or 4 times in 2017, and every time basically we had over 90,000 on the call side on a monthly. It almost nailed it directly to that strike, and that's what we had on the 160 strike. We had a huge amount of open interest at that 160 strike, so we set that up for that target, and it cost $15. Now the upside risk on this would be $265 if it went straight up, but the maximum theoretical profit here is $235 on your cost of 15. So that's your downside risk is $15. And so if it goes to 160, your return on your downside risk, hope it's not getting too confusing to you, would be over 1,500%. The return on that max upside risk would be 89. But based on that option activity at 160 from prior experience, that looked like a great target. So on the 15th, this trade actually went out at $212 profit per spread. So that return on your downside risk of 15, your debit, was a over 1,400% return in 2 days. The risk on the overall return on the overall risk was 80%. So let's go look at the risk profile on this. So again, it starts out, it's basically the combination of a balanced butterfly and then adding an additional credit spread to it. So here's the initial balanced butterfly. So this would be your call butterfly, cost 70 cents on that part of the trade. Okay. Now you can see here it went out almost to the penny, 160 right there. So the balanced butterfly cost $70. So that trade was going out at $175, $175.50 just on that part of the structure. So it's a combination of the balanced butterfly with an additional bear call credit spread. So you can see that was making 175. Now you're going the next part of the trade was adding that bear call credit spread here. So that was selling the 160 short, buying the 162, okay, bear call credit spread, brought in $55 credit. That was going out. It was going out at 160 right there, actually a little bit below. So that was your max profit. If it closed below 160 or less, you'd keep the full credit of 55. You add those two together, and you've got this structure here. So this is what we call the ratio butterfly. And so you can see how a huge return on this because you made the balanced butterfly part of it made 175. The credit spread made a total of 53 from the credit received there. So $228 per option contract, per option spread on that. So that's, you can see where it was going out right there. So your downside risk is $15. Here's your upside risk here, which was $235. But, with that option activity at 160, there was, low chance it was going to scream up in 2 days. So this went, made over $200 per spread on that. So here is the breakdown. Let me put it back here. So here's the actual spread setup. When we set this up, this was costing $15 on the spread cost right here, $15 debit. And it went out and was closing right there into expiration on the day of expiration right here at $159.98. So that went to $227 debit right there. Okay, so that's your $227 debit minus your cost, $212 per spread. So that's, $1,400 return on your at risk of 15 to the downside, 80% return on this $235 here. So pretty much nailed it, but this is a great strategy. And you can do puts or calls, and if you're looking for a upside move, we would use puts. So once you get into it and know how to structure, it's pretty simple once you do it a few times. So if you'd like to learn more on these types of selling option strategies for income, profits, and hedging, I've got a really good package for everybody here. If you'd like to take advantage of it, let me give you the link. Here's the link. It's powercycletrading.com/best, and as part of this package, you're going to get my reversal indicator at no extra cost. So the reversal indicator, let me type that in. That's wrong. Okay, so that should work. If you click on that, it should pull up a payment link. So you're going to get everything here I'm going to show you for just $97 if you sign up here today. So let me click that. Oh, no. Typed something wrong. Oh, misspelled it. Sorry. Hold on. Okay, that should work here. Okay, let me click that. You should be able to just click on that. And good, yeah, pops it up. So you're going to have that link pop up. You can copy and paste it, but you're going to see that that'll pop up, and you're going to see it's $97. And just put in your name, etc. No promo code needed, and you're not seeing the bonuses here. So when you sign up here today, everybody that signs up will get these additional bonuses. So let me show you. So this is a course that I did a couple months back, and now it's on demand. So it's a pretty new course, and it's a 5-hour trading recorded course just on these types of spreads, credit spreads, and then incorporating that to create the condors, butterflies, the ratio spread. So it's a 5-hour plus course, very, very extensive, very detailed course. So you'll get that, and then everything's broken down in the course, 30-minute modules. And then you'll get the training manual. It's very detailed. My courses are very detailed, plus all these additional bonuses. So let's just run through everything, then I'll take questions and go from there. So if you look here, you're going to get the 5-hour recorded course on demand. Now, if you go to my website, this is $297, the course. And as a bonus here for everybody today, you're going to get the cycle reversal indicator. And I've got this for Thinkorswim TradeStation, so you'll get that as a free bonus. And if you go to my website, if you decide not to, it's $197 on the website. Now, we're also going to do a follow-up Q&A, live Q&A, which will also be recorded, so you'll get that as part of the package. And then bonus 2, my strategy manifesto guide, you're going to get that. I'll show you in a minute. Greek power tool guide. These are printouts you can put on your desktop, so it's going to show you some great option strategies, their profile of risk, reward. And then here's the Greeks. So, if you're, hey, what's gamma, theta, et cetera, you can print this out, put on your desktop. And then for anybody here today that's never had a membership to my trading club, you're going to get 1 free month membership, trial membership to that. So it's a, great package. If you like it, it's 389-page PowerPoint manual comes with the course. That's the detailed course manual, plus all the recordings broken down in 30-minute modules of the 5+ hour course. So it's yours forever. And on the Trading Club, you can start it whenever you want. If you don't want to start it today after you buy it, just send us an email telling us, hey, you'd like to start it a month from now, and that'd be fine. So as that bonus surprise, you're going to get the cycle reversal indicator here. And it's based on relative strength. And so it's put together to measure overbought, oversold levels, and then gives you a signal as an advanced, warning to a potential market reversal. Generally, you're going to see it at advanced 1 to 2 periods before, it actually, happens. So it's a kind of a leading indicator. So this, for example, if you had a reversal on a daily bar, daily time frame, it tends to give you that 2-day advance warning that there's a reversal coming. Now, sometimes these can be, very strong reversals. Sometimes they're just, steady and just kind of churn sideways, which makes it perfect either way for, these types of credit spreads. So you get the indicator has an upper study and a lower study, and the lower study will show you the actual overbought, oversold condition plus the reversal signal, okay? And then the upper study is going to give you that cycle high reversal or cycle low reversal, and it'll give you an arrow. So you get a down arrow for a reversal cycle high, or up arrow for a cycle low reversal. And they're great for any time frame. I like to use it for a 5-minute time frame, that 4 hour, you can see 1 hour daily, and even weekly. And these are an indicator that's great to use for your swing trades, day trades, longer term trades, and also use this for spread trades. So a really great indicator. And after you buy it here today, just tell us which platform, or you can have both. If you have Thinkorswim TradeStation, just tell us you'd like it for both. So here you can just kind of see here what you're going to get. Here's the actual signal, and then you get this arrow. So it's very visual. And in the course, you'll also learn how to use this indicator for these types of credit spreads. So that's part of the course. It'll go through on that. Now, part 1 of the course, you're going to learn the option Greeks. These are, vital for your selling options and credit spreads. So you'll learn how to use these Greeks in the course, how, why, and when to use credit spreads to create these low-risk, high-probability directional trades. Also in the course, you'll learn then how to incorporate the reversal indicator for selling these option kind of credit spreads. And then you're going to learn how, why, and when to use that ninja ratio butterfly for your directional trades, the trading advantages of incorporating these ratio butterflies. Also, we'll go into depth in the course on credit spreads on stocks and index options such as SPX, RUT, and the NASDAQ 100. So I'd like to do credit spreads on these indexes and teach you in the course how to do that, and where to put them on. Do you go 5 days out, 10, 20 days out? So I've got kind of a formula that I show you how to set these up, 5, 10, 20 days out, and what you need to do as far as the minimum amount of credit to receive, formula that I use that I'll teach you in the course. And then, how to use these credit spreads and the butterfly spread for hedging, okay? So this is a great way to hedge core positions that are going against you, so teach you that. And then another big part of this course is when you do a credit spread, how do you defend it so you don't lose the full amount of your at risk? So I'll give you in this course 6 different defenses for your credit spreads. And a big part of the course are these condors. So I love the condor spread, so that's a big part. Position sizing, so to reduce your risk, doing a combination of credit spreads and other types of spreads, it really helps you to reduce your risk exposure. And step-by-step guide for executing the trades, and you get a really good trading library of different trade setups, credit spreads, butterflies, etc. So very, very extensive course and package. And here's a little feedback. This was from Debbie. Said, Larry, I've been doing the ninja flies, and they're the most incredible way to put an option position on. I have huge gains from the SPX trades that I've done. Thanks for teaching me this option strategy. Can't wait for the next course. Here's another nice compliment here. This was from RH. Just want to say again, what a terrific job you're doing on the options and tool teaching sessions. You have provided us with such an amazing amount of extremely valuable information and tools, and your ability to teach what you've so cleverly created is simply amazing. Thank you very much for caring about us students, providing us with all the great tools and guidance, and for doing such a terrific job. HR, PhD. So a little, testimonial feedback there. So again, just kind of going through here, you can get the step-by-step blueprint course, my selling option for income, profits, and hedging, 5-hour plus course, recorded, broken in 30-minute modules, 389-page training manual, of course, very detailed. This is on the cloud, or you can print it out, and it's yours as long as you want it. You'll get the follow-up Q&A, which will be probably in about 2 weeks, which will also be recorded, so you can come in and ask whatever questions you have that you're kind of confused on, or ask questions about trade setups. And then the other bonus, you'll get my 15 option strategy guides. So these are some of my favorite option strategies, showing you the risk profile, defining what the risk reward is, how they set up, what they are. And then you're also going to get this option reference guide. So you can print this out, put it on your desk to tell you, the various Greeks, what they are, what they do. And if you've never been a trading club member, you'll get a trial membership. And if you then stay on, it's $97 a month. So just use that link there I just gave you, powercycletrading.com/best. And that'll get you everything here in this package. So our trading club, we have a virtual trading room, opens at 9:25 a.m. in for the first hour, and then back in for the close. Do daily market videos every day, showing you, my take on the market, the trade setups that we're looking at, either swing trades or even day trades that we were looking at. We do a weekly Q&A every week. Okay, so that's also a weekly benefit to all the members, which is also recorded. A nice Trader's Educational Vault, and for every month you're a paying member, you'll get a $20 credit. Okay, so you can accumulate credits and then buy, whatever I have on my website. And you'll also get 50% discounts on all courses and trading software. So a very great package, great way to start the new year out, very little money to expend, and a great investment in yourself. So hopefully everybody here will sign up, take advantage of it. Again, use this link. Okay, there you go. And appreciate everybody being here today. Let me see if I've got some questions here. I got a little bit of time left. Can everybody see it okay? Sometimes there gets to be a little bit of a lag here on the screen. Can you see it okay now? John, I don't know. I don't have that information for you. Yeah, it absolutely works for foreign exchange. Let me pull up the indicators you can see. What would you like to look at? Foreign exchange. Put in, we can put in euro dollar or something like that. So here's the euro dollar cross. Okay, so here's just this reversal indicator here. Well, okay. Well, that was a beautiful reversal indicator here. Reversal right there. You can see on the 19th of December. Okay, beautiful. Look at that. The 9th of November. Now here's my full package of indicators, but here today you're going to get the cycle reversal, but these are also the momentum indicators that we use. So I like to incorporate momentum to see if there's momentum in price. And for example, this, if you're trading foreign exchange, that was a beautiful signal there. You can see the reversal, and then you can see momentum. Cycle 1 and 2 were positive, so you had a really nice push to the upside, and this is what we call a volatility squeeze, these dots. Okay, so yeah, so here's reversals here, cycle reversal high, reversal low. So that's a look there, and here we look at another cross. You're not going to get the, okay, this is a bonus, So you're not going to get it right away. You need to send us an email, support@PowerCycle Tell us what platform you want, and then we'll send you the instructions and the code. Okay, send us an email there. And everybody's interested, obviously, in Bitcoin. Here's just a Bitcoin futures. So that's right. Any other? So those are, you know, a few things you can look at, but that's the cycle reversal indicator. Here's a Bitcoin stock that we've been kind of watching. Look at that! Wow, crazy. And here's another cross. Here's U.S. dollar, yen. So really nice short trade setup there. See that cycle reversal plus momentum reversals here? And pretty much nailed it. Here's cycle reversal low on yen. See that? It's right down here, 1128. So that's a look at the crosses. And so basically, you know, we have the trading room, and most of the trade setups and things are done there. So come in the first hour to look at that. And then also in the nightly videos, anything that's setting up, we'll look at that. I'll go through it on the nightly videos. Here's another, gold. Here's an example of gold. Wow. So here's your cycle reversal, gold on the 15th right here. And then here is momentum. So our actual trade setup trigger buy was right here on the 21st, right there. So here's your reversal, okay? So that we use that as an indication of a potential cycle change. And then we incorporate momentum. So we had cycle 1 and 2 momentum positive. So that would have been our buy signal right there, and then exploded. Here's win. Here's the win trade, short trade setup. We did this. So it came down again. I always incorporate Fibonacci. So our first target was right here today at 618, and it actually went below that. So it took some profits here intraday. Cycle reversal. And here's Alibaba yesterday. Again, I like to incorporate and use lower time frames too. I like to use the 4-hour. So you can see a nice cycle reversal on the 4-hour. And this was in a volatility squeeze, so we had a nice push. Now it came into our target here today, first target right there, about 185. So this is a trade we actually converted to a condor. This was set up yesterday with a call debit spread, and when it hit our first target, converted this to the condor. And here's what that looks like. I'll pull that up real quick. So set this up, did the yesterday the call debit spread, and bought the 182, 185 at 98, okay? And then when it flipped up there to that first target on Fib, sold the bear call credit spread, the 192.5, 195. So now we've got this condor, and reduced the risk down to $54 to the downside, 54 upside, but we've got this huge profit zone in here. So that's an example. So I think that's about it. I appreciate everybody letting me have a little bit of your time here today, and I look forward to hopefully working with a lot of you guys and gals in the future. So good luck trading. And MetaTrader 4, no, I do not have it for MetaTrader 4. And thanks again for having me here today. Good luck, everybody, and look forward to working with a lot of you in the future. Thanks again.